unfortunately, the metrics at this level go out the window, because you're not going to sit there and do the usual due diligence that you would want to. We're talking about a business that is sinking.
Hi everyone, welcome to the Next Level Finance Podcast, Series 2, Episode 10, and we have Peter.
Hi, Z.
And this is the only person we've had for the second time because he's got some huge value to add, and we're going to enjoy this podcast. Hope you do as well. As many people will know, if you watch Series 1, Episode 2, I believe it was, when we had Peter before, and any intro that you want to talk about, understand from Peter's perspective, his personal challenges, all the rest, we covered in that. This one is going to be straight to business. Peter, thank you for coming to our podcast again. Second time, you're a veteran now.
Something like that, yeah.
And the reason why we got Peter, because he's got some huge value, and we're going to talk about this. In this podcast, it's all going to be about acquisitions out of insolvency. Or I say insolvency, I should say. And this is what he's been involved in a couple of decades and is really accelerating on this. And we wanted to go through this podcast. What's the process on this? Because we've got a lot of entrepreneurs who watch our podcast and they want to know how can they scale their business. Do you think buying out of insolvency or pre-packs and things we're going to discuss is still a good strong way straight into it?
Now so more than ever, really, because of the amount of opportunity there is. Insolvency rates are still running very hot.
Wow.
The larger companies are still being affected, but in the SME world, even more so from kind of a cash flow perspective and just generally trying to do business in the UK at the moment is very, very tough. So
just for everyone, we're talking in November 2025. Whenever you're watching this, you always got to look at the environment. That's what Peter's alluding to. Sorry, Peter.
No worries. So in terms of the opportunity for SMEs, what is traditionally known as M&A, mergers and acquisitions, is a very carefully planned, huge amount of due diligence. There's a lot of strategy behind the deal and the deal making, whilst when you're buying out of insolvency, it is effectively very similar to buying at an auction. You've got to move at the speed of light. The opportunities are there. You just got to act fast, swiftly, decisively. But you
just to break that up, that's a really good point. Just to kick off as we're getting straight into the action, Peter suggested, because Peter's an insolvency practitioner, been involved in it a couple of decades, and you'll see from his intro in the previous series, Series 1, Episode 2, where we talked a lot about Peter's journey. So if you want to learn a bit more about Peter, watch that one as well. But we're going to get straight into a certain business area, which he's talking about is buying businesses out of insolvency, and why people like Peter, one of the business advisors involved in the transaction, are so important, and he's giving you the opportunities. Sorry, Peter, please.
Okay. So in terms of what it looks like in insolvency, it's a distressed business. It's a distressed business for a reason. Again, think about it like a property. Yeah. Is there subsidence? Probably. Is there a cash flow problem? Most definitely. So I think the first place to start, and we did mention this off air, is the distinction between a pre-pack administration and a trading administration.
Just the point before you made, which is I think a really key point, is when you go to an insolvency practitioner and you buy something out of insolvency, Peter made that distinction about it buying like you're buying a property from auction. So we've got a lot of different type of entrepreneurs run trading business of us property entrepreneurs, and they probably will understand. You normally have 30 days in auction. I think you said about a couple of weeks. A lot of time.
Usually in a pre-pack liquidation process, you're looking at about 2 weeks.
Wow.
Maybe less, because 2 weeks is from the day that marketing begins, and you're usually filing the notice of intention to appoint or the appointment documents at court 2 weeks down the line.
I think this is one of the challenges that you were talking about. You said some of the business challenges of buying insolvency is cut through the BS, as Peter was saying. We're all out here. We don't care. We just say how it is. There's a lot of bullshit, right?
Absolutely.
So how do you, out of the noise, because the noise comes before the fun and the pain.
Absolutely.
Before you get the pleasure.
Absolutely. So You've got the distressed business. In a pre-pack scenario, the administrator's unable to trade the business, usually through cash flow restraints,
Yeah.
but also that you've done an assessment to say, well, actually, the cost of trading this business is going to be X, and the realizable value is unlikely to cover the cost of trading.
Yeah.
So what we're saying here is that we probably got a business with very, very low cash reserves. We don't have the runway to continue to trade. So what we need to do is find a buyer yesterday in order to rescue the business, safeguard jobs, and retain the value in the business, whether that's the intellectual property or the contracts and things like that.
So what Peter's saying about IP, intellectual property, that's the knowledge in the business and whether it's been preserved, and that's what drives the value. So the IP is what's in people's minds and how they put that into a business, either systemize it, etc., etc., to then generate revenue and therefore make some money.
Yeah.
Sorry.
So when we talk about brand value, we're talking about what ultimately generates the turnover. So when you're looking at, and we spoke about this again in terms of, you asked me, what are the fundamentals that you're looking for? Unfortunately, the metrics at this level go out the window, because you're not going to sit there and do the usual due diligence that you would want to. We're talking about a business that is sinking or has sunk.
You mentioned brand, and I want to touch that because we do a lot of socials and all this, and your personal brand. For me, our business, the personal brand has been a game changer. It's helped us so much stuff, like getting onto certain things like Sky TV, loads of different things. But obviously, when you're buying a business, the personal brand of the person is going to disappear because they're going to sell it to you or sell the business to you. Then the brand value is nothing, really, is it? It's hard to get.
From if you're looking at an owner-managed business, absolutely. There's a lot stuck with usually the director or whoever the key individual is within that business.
How do you manage the expectations because of that? Because I think you're trying to get value and you're putting numbers and you're having to do it quick time, literally. Right? If they're trying to value the brand, and I know we didn't speak detail, but this is such a huge point that you just made. How do you have that conversation with them, saying, "Look, mate, your business or Mrs. Your business is going bust." How do you get them to agree and sort of deflate this brand impact, even if there was there, because it's different going forward?
So two things come to mind. One, you mentioned the word value, so the brand value, and that is, in insolvency world, very, very difficult to gauge. So that's why you have to conduct a marketing process, and ultimately it's whatever someone is willing to pay for it, which is usually the case, but it's also what somebody's willing to pay for it within the timescales that we have to transact in. Because we only have a 2-week, 3-week runway, we need to find a buyer because time costs money, and in insolvency world, you're going to run out of steam, you're going to run out of cash, you're going to start losing contracts, you're going to start losing employees, and all of a sudden the business can disintegrate. I'll give you a prime example of that in terms of kind of Debenhams was a lot more complicated, but a similar type scenario. So coming back to your original question, in terms of the individual, look, it's all in the negotiation. So an owner manager, the management team can club together to buy the business back out of insolvency. There is a mechanism within the Insolvency Act that enables connected parties to buy the business back.
Just to give context to the audience, what size of businesses, we're going to talk about revenue, the sales. What kind of sales are these owner-managed businesses typically that you're seeing?
So typically there needs to be an underlying business behind it, of a certain stature, because of the costs involved in trying to rescue the business. So your average kind of administration, even your smallest one, will probably come in with about 50 grand worth of fees. In terms of legal fees, court fees, administrator fees.
And that's who pays that? The seller or the person who?
So usually the vast majority of that will come out of the sale proceeds before it goes to the order of priority, which in these days, depending on how the sale is split between fixed and floating charge assets, it's quite a complicated kind of calculation as to who gets what. But like in most things, professional services fees come at the top. Then it's the bank and the charge holders, employees, HMRC is secondary preferential, and then the unsecured creditors at the bottom. But in short, and answer to your question, usually it'll come out of sale proceeds.
And normally the revenue, as we're saying, about £500,000, £1 million revenue.
Yeah.
Because other people just close it, don't they? They don't.
Yeah, exactly. So there needs to be an underlying business to rescue.
Yeah. So if you're looking 50 grand in my head, if it's under £500,000, that's like 10%. Of revenue, so it's got to be something that's going to be substantial.
Yeah, the sale price has to be north of a basic figure to cover costs. One thing that it is important to consider, very few people think of the administrator's role and what they need to achieve. So the starting point is that you have to achieve a statutory purpose. You have to do one of three things. If I've got a struggling business in front of me, I've had a conversation with the agents who market these types of businesses.
Statutory means a legal process, if people didn't understand what statutory meant.
So it's either rescue the business as a going concern, i.e. find a buyer who's going to walk in and just take on the business.
Right.
That's ideal world, right? You rescue jobs, you rescue the contracts, the supply chain, and it's business as usual.
What kind of... So imagine, we're just talking about business valuations. Say your business normally would go 3 times EBITDA or something like this, depending on industry, before people start and size of the business. Right? Obviously, these are making losses. Right? Imagine your revenue is £500,000 or is at that time of the business, but it's making a loss. What kind of discount would someone be looking at? Because people are going to ask me,
Absolutely.
Why would I go take this risk, get a non-profit making business, because I can go and get a profit making business,
Correct.
£500,000, say 30% EBITDA, that's 150 grand before tax. Only before interest, tax, depreciation, amortization. A little metric everyone uses. So imagine I've got 150 grand profit and I normally would pay, 3 times? 2-3 times, 300 to 450 grand over a number of years. I know what I'm getting. I'm already getting a profit. Why am I going to take a risk and buy a pre-pack? Told you I'm going to ask them the tough questions.
So quite simply, it's because metrics are out the window. So the benchmark is, what would this business be worth in a liquidation scenario? So you've got the value of the physical assets on a breakup basis. That's your starting point. Then it's, well, actually, if you're buying the whole or substantially the whole of the business, then automatically you've got retained value. So what is the ability of this dying ember to generate you turnover? So the value of the contracts and the brand value. Valuation agents have very, they'll probably shoot me for saying this, but very rudimentary calculations based on the ability to kind of regenerate that turnover out of what's left. But this all comes down to what somebody's willing to pay for it in that 2 to 3 week window before this thing falls off a cliff edge. So the value is actually in the opportunity. So, will it be substantially cheaper buying and taking the risk in this particular scenario? Absolutely, because you're competing only against those who have the ability to transact within this very narrow and specific set of circumstances.
It seems like, for me, the savvy owners would definitely need to have a team like yourself involved, because what they're trying to get at is, can I rescue revenue, basically? That's how I see it. And does that revenue, I guess when people are doing what we call M&A, mergers, acquisitions, they're in the industry and they want to expand, or they're buying supply chain, or in the supply chain someone before them or after, to increase their offering. If this fits in there, they're the people that want to be buying, right? So for example, us, maybe accountancy practices, financial advisors, wealth, depending how we want to do stuff.
Absolutely. It was only this week in the news that I think it was like 170-year-old law firm was sold in a pre-pack to I think it was HCR Law. So that's a prime example of a law firm with a substantial following, but for various business reasons, partners were leaving. Business was then going the wrong way. Very, very difficult to trade a.
Was that an LLP they bought? Do you know? Normally law firms are LLPs.
I'm not entirely sure.
The reason why I mention is the structure, and we had this conversation before, whether you buy a limited company LLP, it is different. Because if you get an LLP, you probably need an LLP to buy an LLP, because what you're doing is they're getting partners, unless you become what we call mixed LLP, which is quite, if you've got a limited company, having an LLP and becoming one of the partners. So it's very different in professional services when you're buying.
Correct. However, 99% of the time when it's an insolvency scenario, the purchaser is coming in and buying the whole or substantially the whole of the business. But effectively what they're doing is they're buying all the good bits out of the business and putting it into their company. The shell of the company stays with the administrator because all the liabilities are in that shell.
This is a really good point. And we were going to talk about when you go and buy a business, you normally buy in two different ways. You either buy the shares or the assets. And that is very different. Here, they call it a share purchase agreement, SPA, when you buy shares. This is not in insolvency world, which Peter's talking about, and we're going to touch this. You generally buy assets.
You buy assets
because of the reason you just mentioned.
Yeah, absolutely. So you're getting the good bits, you're leaving back the bad bits with the administrator, and off you go. So typically, once the business is sold in a pre-pack scenario, it is that the deal is done on the first action the administrator takes is signing off that sale, because they can't trade the business. So you would have an SPA in that scenario, but the assets, the contracts, the employees, the physical assets, the intellectual property, all move across to the purchaser, and the limited company or LLP or whatever the current business structure is, its name usually changes to XYZ Limited asset realizations. So that there is no kind of hangover or distinction between the business that's.
Can you buy the business name part of the?
Absolutely. So it's part of the goodwill.
So it's not what I call a SPA sort of thing, because you're not actually buying the shares. You're
not buying the shares
within the wrapper. You're buying what's in there, and then leaving all the rubbish behind.
Absolutely.
As long as you can identify what the good stuff and the rubbish stuff is.
Yeah. One thing that I would say, so you're spot on in terms of identifying what the good stuff and what the rubbish stuff is, because you do not have time to do a full due diligence. You're not going to achieve much in 1 week.
Right.
And in the sales agreement that is signed off by someone like me, is right at the very end, it says the administrator acts as agent without personal liability, number one. Number two, that in legalese, I don't know what I'm selling.
What you have to have is, you really got to understand what you're buying. A lot of pressure, just like an auction.
Yeah.
When you go and buy auction, if you have lack of time, and a lot of people have to do pre-work.
Yes.
And there's cost to it. So they have to weigh up doing the cost and maybe not buy in. Working out what value will that go for. Is it worth it? Because you have to put so much money with the agents and all this stuff. And if you don't,
and also working capital requirements, because it's not a one-off. You know, you're buying a business on its knees. So you need to figure out what it is that it's not even the purchase price that you got to actually figure out. It's I'm going to commit to this, but actually my total exposure might be 3, 6 months, 12 months. How long is it going to take to turn this ship around? And is it that I'm plugging it into an existing business, in which case I have the rest of the infrastructure, don't need to worry about that?
Normally what I've noticed is that businesses that are bought out of insolvency, and I know you'll have a lot more insight, what I've seen is people make money where they've got a business that can incorporate the current business.
Yeah.
They get the revenue,
Yep.
They get supporting to support that revenue, but they've got the infrastructure and they know how to run it more efficiently.
Absolutely.
Number one, so important.
Yeah.
And number two, which is quite a big one, they know where the synergies are. Right, so when they take risk, they know I'm going to buy all this revenue. I may buy some liabilities without knowing, right? But generally,
Yep.
I'm leaving the big stuff thing, and then I can cherry pick certain assets I need, because I guess on the pound, I'm paying as low as bottom dollar that you can, because I
Because of
don't
the level
know.
of risk.
Yeah, because the risk's higher,
Yeah.
and a lot of people I've seen being successful have done this. But the biggest issue I've seen, and I know you'll touch on this big time, is when you buy, remember you're buying employees as well, potentially, to support that.
Yeah.
Because they go
Yeah.
This is where it gets really tricky. Because
it's where the risk is. Absolutely, because with TUPE, which is an acronym for Employee Contract Transfer Over to the Purchaser, and the protection of employees' rights.
What a
you need to be wise to the fact that it's very, very difficult to cherry pick. There's a lot of legislation about redundancies just before an administration or as a result of the process. So you're kind of working on the premise that you're going to be adopting the employees.
And I think there's a minimum time normally, like 6 to 12 months, what normally people have, and then they assess, and then they do a reorganization. This is normal process, what I've seen. Like, for example, if you're buying a business and it's got its own main office, you may want to chop that, but that may not happen overnight.
Unlikely to happen
because
as part of a
minimum set of time.
as the purchase,
and depending on the agreement. And number two, staff. So some fixed assets, also staff are the key. That's where the value is, because obviously that operating model, for whatever reason, was not working, and you'd have to know why it wasn't working, and also know, can you do it better than the other person? And this comes back to, well, I say M&A.
Yep.
Are you buying something that you've got no experience and knowledge?
Yeah.
Because if you're going down this path, you've got to understand that industry, right?
Absolutely. You got to understand. You're spot on when you said you got to understand the business model, why it went wrong, and also have the cash reserves, the knowledge and the time to be able to give it, to nurse it back to full health. And that's how you achieve the value, by taking what it is, the state of play as at the time of purchase out of, say, administration, and where you're going to take the business to. I often think of it as, it's burning embers, and you try and resurrect it to bring the fire back to life.
Do you think, I know we're getting to, and we'll get into all the different types later, but a really good leading question from this for me is, what is the number one, or say top 2 or 3 determining factors why that business is in distress and gone insolvency? For example, is it pricing, marketing? What are the things that you commonly find that they're not doing, and where there's opportunities?
A common theme is the governance of the company. So if things are not really working very well in terms of the management team, and not everyone's pulling in the right direction, that filters down to absolutely every corner of the business.
Yeah.
So, I can probably just have a look at a company's house and seen a whole bunch of resignations of directorships without even having a look at what the balance sheet looks like or the financials of the business. I was like, something's going on here.
I think you've hit the thing, and I think this is where the opportunities are. We have got issues with talent in the UK. I'm sorry, but I know people may not like that popular question. I think the mindset, and you're only as good as your team. And are you finding, especially now, entrepreneurs are finding it harder to deliver what they could previously in UK-based businesses?
Yes, and one could argue that's directly linked to the efficiency and output of UK PLC, where you look at how efficient the UK is versus, I don't know, other European countries such as Germany, and you think, well, hang on a minute, what is it that we are doing fundamentally different, where we're not achieving the same result with the same level of input and cash in, you do have some difficult questions to answer.
I think that's a really good answer on that, because we call it productivity. It's how much people produce. Ultimately, as an entrepreneur, you make money on the production of you and your team at a profit, make a margin, right? And I heard the Chancellor recently, no disrespect to the Chancellor, not always a fan, but
Agreed.
She did make a valid point, and you have to agree, and she said productivity in the UK is struggling. But I think how she's addressing that productivity problem isn't, her and people like Angela Rayner before her, is not going to improve it. You have to get a balance between employer rights and employee rights. And you have to create an environment which works and incentivizes people to work, to get benefit as much as the people employing them. And I just don't see that.
It's just to cut the red tape, basically, and allow people to do what people do best.
We've seen this cycle previously in the 70s, and I think we've been going down this cycle for the last probably decade or so for different aspects. We are not incentivizing people to work, and we are not incentivizing people to employ people, because the cost of doing it, the compliance,
the risk and reward is not quite right at the minute.
Do you feel that's really affecting owner managed businesses, especially who are struggling to adapt? Because employing people now is all my days. I'm finding it is one of the biggest challenges.
Absolutely, and it's kind of it's slowly, it's over time that this has happened. So you factor in, let's look at either construction or hospitality, two areas of the UK where insolvency rates are highest, and they're impacted by minimum wages. Construction and hospitality. Usually top of the insolvency league table, as sad as that sounds.
Is it people the biggest problem?
And fundamentally, yes. Because
people don't want to work.
You slowly had change over time. You've had changes to minimum wage. You've then had the introduction of pensions, 3% on top of that across the board. So it's just slowly but surely increasing the costs of people heavy industries, where in both of those particular sectors the profit margins are small. So it's then harder to do business, and that's putting aside the rest of the economic headwinds that we've experienced over the last 10 years.
It's amazing value there. You're understanding what issues entrepreneurs are. How do you then, obviously, why you're tracking them? What's the key areas you need to look about on acquisition? I guess, what's your approach? Because everyone has different approaches. Obviously, you're on the side of the vendor, the person on liquidation, seller, whatever you want to, whether they're selling or not is a different case. Really trying to do it. What's your key approach to make these deals happen, or the business obviously will not be there? So how do we do it?
To my mind, it's mentality. It's understanding and managing expectation. You've got to think of it. I mean, one could argue it's a bit like Delboy. No warranties, no guarantees. That if you read through a contract of a sale of a business out of insolvency, that is what you get.
Mic drop, right? Bite size, I love it.
I have no idea what the contracts. I haven't done an in-depth analysis of the contracts. There may be clauses in there on insolvency. There might be various other clauses that would render them non-novatable. You might have very specific business problems that we're simply not aware of it as the selling administrators. You might have scenarios where staff may be particularly loyal to the founder, to the owner, and not willing to move across, even though they have the right to be TUPE'd across. So you've got to then find out who your key people are, and potentially have some conversations to make sure that they remain on board. So it's not only do you have to be able to transact very quickly, you've got to be of the acceptance that due diligence, the normal due diligence level of comfort that you would want to have is simply not attainable. So you've got to think very strategically about what are the most important things that I need to lock in. And it's usually how do I maintain recurring income? So you're looking at the contracts and the main delivery channels. And how do I secure them in terms of key suppliers and key personnel? So you only have time to critically analyze 2 or 3 pillars. The rest you've got to take it on the fly, knowing that if you can deliver the core bits, then there should be sufficient discount and value for you then to take a chin on anything else that is outside of those core bits.
I think that's a great point, because I think the motivations we were talking about of the seller or the person who's in there, is it to get some money out of this or selling price, or is it to protect the ongoing business?
The seller at this point, it's in insolvency, right? So the director's powers are pretty much gone.
Right.
So the administrator's in office, and I've got to either rescue the business as a going concern, achieve a better outcome than the liquidation. The example I gave of the value of the assets if I was to sell them at auction versus what I can get as a whole, or I do something, sell something to either pay the charge holder or some of the other creditor classes, either most likely the employees or HMRC. So that's the aim of the game. The motivation, to answer your question, the motivation of the seller, i.e. the administrator,
who's taking
is to achieve one of those 3 things. Fundamentally, it is always achieving the best possible outcome for creditors, and 99 times out of 100, that means obtaining the highest possible price. The but I would say is that it's not always the highest offer that is the right one to take forward. So as strange as that sounds, it is that there needs to be evidence of the funding. It needs to be a well-oiled machine that's taking over, because then there's kind of risk element that the administrator and the agents who are undertaking the sale process and ultimately going to give a letter of recommendation on which offer to accept. It's got to be the whole thing as a package, because if there isn't a huge amount of difference in terms of 2 competing offers, which offer is then best placed to actually transact, that falls into it. And again, it's very similar to if you're selling your house and there's $5,000 difference between the 2. You've got one buyer who's a cash buyer and another one who's in a huge chain. The insolvency version of that is someone who has the ability to transact and you can do the deal, versus the uncertainty of a different type of deal.
I think what I want to explore is, and I think that's a really good insight you've given to explore, that, when you're buying, no one wants to buy the liability. So does the person, when you're buying, unlike when you're doing liquidation, they don't really care about the creditors. They don't want any of those.
No, they
just want
they stay with the administrator. Yeah.
So how do you get that balance right? What the creditors potentially want to what the buyer, who's ultimately calling the shots here, really, shouldn't it? Because the buyer is, if they don't get a value from this, they don't want to pick up no liabilities. If I'm buying a business as a buyer, if I go to yourself and I'll say, look, I don't want to buy any liabilities.
And you wouldn't.
Yeah, exactly. So, but you have to bear in mind the liabilities, because the cash that you're getting is to give the creditors
something back.
Yeah, because they've got to make a decision ultimately, don't they?
Correct. Yes and no.
Okay.
Yes and no. So in a pre-pack scenario, the deal is already agreed before the creditors are even at the table. So before any of the creditors receive any communication that the company has gone into administration, the deal is already agreed. So that kind of...
but can they overrule that pre-pack?
Can they overrule that pre-pack? It can be challenged. However, because of the powers of the administrator as a trusted professional and the obligations that they have, it's the administrator who justifies the action. So the deal's done, and then the presentation is made to the creditors by way of a proposal that the creditors may or can object to. But I think that thought process that you're referring to happens way earlier. So when directors come to me for some advice, I look at it and assess the options. So can you rescue the business by way of a CVA, a creditor's voluntary arrangement, that basically keeps everything in the same lane, everything in the same company, but and we continue to trade out the business and pay the creditors off over a period of time, 3 to 5 years.
Subject to the agreement.
So, subject to the creditors' agreement. Quite
That's
right.
your first option.
That's the first option. And even before then, there's a whole bunch of informal options, such as, what can they do to sort out if it's cash flow issue or whatever else issue, before we look at even the formal insolvency procedures. So we're at a fork in the road where we're assessing what the value of the business potentially might be. If there's no real value in the business, or we don't think that there is anyone in the market for it, then it's most likely going to be a liquidation, and then you're just selling the physical assets. In order to go down the administration route, the administrator would have done an assessment on the outcomes.
So there's two types that you've told me.
Yeah.
There's one is obviously pre-packs that we were talking about, and the other one is buying while in administration.
While trading.
While trading.
Yeah.
But so how do you decide which one? Tell us a bit more about it so the entrepreneurs can understand.
Sure. So, you're sat in front of company directors and you're thinking, well, this is usually a mess. It's usually a mess. And it's, what's the best way to recover from this mess? Now, more often than not, people come too late to me. So the cash reserves are out. It's usually we have payroll next week and we can't make it.
Got it.
So continuing to trade is difficult. In an ideal world, you would be trading the business for 4 to 8 weeks, doing an extended marketing period to enable all potential purchasers as much possible time to do due diligence in order to then have a higher sale price. You're also trading the business so that you maintain as much of that kind of goodwill and continuity, and then you have a much softer landing as part of the sale. Now, there might be times where you've got a large clearing bank who are the charge holders, have a fixed and floating charge over the company. You go to them, have a conversation, say, look, guys, if we have an extended marketing period on this, we think the agents think that the value of the business is between here and here. Will you fund trading for the next 4 to 6 weeks with a view to us achieving that? But that's all, in best case world scenario. Usually we haven't got enough cash to trade effectively. So whilst we're onboarding the company to place it into administration, there'll be a marketing exercise done, call it M&A, but at lightning speed.
So and this is trading.
This is non-trading.
This is non-trading.
So the business is still operating, but on almost like on life support. The directors are trying to plug holes. In the meantime, we're gearing up to placing the company into administration.
Got it.
So in that two week marketing period, we'll identify a buyer. That buyer then will receive get access to a data room, a bit like you do a legal pack in a property auction.
Wow.
That's your lot. You can ask some questions, but I'm Del Boy, no warranties, no guarantees. I have been involved in the business maybe for a couple of days. I don't know the answer. The directors may know the answer. We'll do our best. So you then, got to then finance this, put your offer on the table. And let's say, that particular offer is then the one that's recommended by the agents. We place the company into administration, sign the sales agreement, and that deal is done.
So this
done in 2 weeks.
So this trading is like literally on steroids, isn't it? Because
the trading is. I'll give you an example.
Is that non-trading or trading example?
The example that I gave you with a 2 week lead time is a non-trading. So the administrator is not trading the business. The sale happens on minute 1 of the administrator's appointment. If you take the example of Debenhams, high-profile administration, the idea of that was to find a buyer for all the sites and rescue Debenhams as a going concern. So, they traded it. It's reasonable to assume that there would be a buyer for Debenhams, right? It's reasonable to assume. However, it quickly became apparent that, these leases and all these properties, this huge cost base, there was no buyer thinking that's a good idea.
Yeah.
So in the end, what was sold was the brand, was the website, and all the leases and and everything else that was high cost got left behind. So whilst it was a trading administration with a view to finding a buyer to take the whole thing, didn't quite work out that way.
So they ended up buying the assets.
It ended up just the bit that was of value was the trading style, was the website, was the intellectual property.
So they closed all their premises down, didn't they? And cut all the costs.
All the costs.
So you just put it on the website and kept the brand Debenhams.
Exactly that.
And I think that made it profitable, right?
I believe so.
Right. So yeah, see, that is quite interesting, the solution that they found. So the other one is pre-packed.
Yeah. So
Pre-packed
is where the administrator hasn't got the luxury of exploring options and keeping the business going, because especially if the business is substantially loss making, and there isn't that notion that, you know, with an extended marketing period we'll achieve more, then the safest route, and sometimes the only route where there's no cash, is that the marketing is done at the same time that the onboarding and due diligence to placing the company into administration is done. And so the marketing and the sale are all pre-agreed in a 2 to 3 week window.
Wow. Okay. So you've got understanding now of pre-pack, non-trading and trading.
Yep.
Loads of variations. That'd be interesting to that. I think you mentioned Debenhams of one of the examples where they've obviously done, was that considered trading? Was that one?
It was a trading administration because you keep the stores open, and you're hoping that a white knight comes and takes everything for some serious money. At the same time, the strategy, if that doesn't work out, is that you're doing a fire sale of all the stock. Because, you know, if you're selling to the public at 50% of the
market
of the normal price, you're probably at cost price. Whilst if you were to put it in an insolvency auction, you get 10p in the pound. You'd probably be selling it at 10% of what you bought it for in the first place, as opposed to even in a liquidation sale, and you're saying 50% off liquidation still, you're probably getting close to 100% what you paid for it wholesale.
Right. So you're just covering costs.
You're covering costs whilst you're exploring, because time costs money, you're exploring the market to try and find that white knight.
So normally the white knight doesn't come, right? So especially smaller businesses, I think one of the things that you've really explored quite well is in this process is the speed.
Absolutely.
And having investment and understanding the cash flow, right? So key issues are, can I cover cash flow?
Yep.
Have I got money to actually purchase or make an on offer?
How would I structure the deal?
Those are the two. So often, what penny in the pound you mentioned earlier, you said normally insolvency 10p on the pound that you normally get.
On stock, you're looking at 10p in the pound,
What about the IP and all that stuff? What do normally people price that? That's a complicated one.
It's very difficult to assess because it's always what somebody's willing to pay for it.
But if someone's only willing to pay 1p in the pound, have you done those sales?
Have we done a sale? I mean, the deal's got to stack up from a cost perspective. Now, usually what happens is that a figure isn't put on the intellectual property,
right?
And you let the market dictate. And where you've got competing offers, it then kind of levels itself out. It's what someone's willing to pay for it in a 2-week fire sale.
I've seen quite a smart, savvy entrepreneurs pay the fees for the liquidation and all this stuff, or the solvency process, £1 on top. That's quite a common one I've seen, where people really, because it depends, your job gets to the point, I've got no seller buyers, I need to do something here, because we need to get something for the creditors, or we need to get this because the business is going to go, and I've got all these employees. So if the business is when you take the cost on, because that's what they're doing, they're not going to pay anything to the current people, or very limited, like £1. They're going to say, hold on, I'm taking all this risk.
Look, there's loads of different ways of structuring it. Often you have deferred consideration in these kind of scenarios.
So is deferred consideration a lot of times used in this?
I mean, absolutely, because in an
What's the deferred
administration.
consideration?
Deferred consideration is, let's say the deal was done at £100,000.
Yeah.
The purchaser is probably thinking, well, I need about £500,000 in terms of cash flow for stabilising this business. And if they haven't got all of that cash up front, they might say to the administrator, look, my offer is £50,000 up front and £10,000 a month. And there might well be kind of uplifts.
Is this for cash flow or giving it to the current owner?
Well, it goes to the administration estate.
Right.
So the current owner, the minute that they are placing the company into administration, once it's in administration, the powers of the director cease.
Yeah.
So all the money comes to the administrator, and it's the administrator's job to dish it out accordingly. But coming back to what I mentioned before about the kind of best offer, if you had someone with £100,000 cash up front on day one, and you had someone at £110,000, but it's all in deferred consideration, and there were a couple of other caveats thrown into that deal, whilst £100,000 is like, I am able to do this deal on day one unequivocally with no strings. You'd like to think that the best option for the creditors is the one without the uncertainty.
I think the deferred consideration is the smartest way to buy businesses.
Absolutely.
Because
from the buyer's perspective,
yeah, and the buyer ultimately, without the buyer, there's no deal, right?
Yeah, I'm just giving an example. If you had two competing offers,
right.
It's not always the highest. It's also the deal structure and the risk of that deal structure going south.
You would caveat it depending on certain milestones.
Yeah, I mean, so if you're a savvy buyer, you would want to be kind of protecting your cash flow to a certain extent and what it is that you want to do. But ultimately, the deal also has to stack up for the creditors. So I've seen options of deferred considerations, but then that needs to be secured either by way of a personal guarantee and or fixed and floating charge on the new company. Similarly, I've seen deals whereby there is an uplift if certain milestones are achieved. So, I can see this business, I can see what the turnover was last year and the year before. I can see that it's, on the way down. However, I will offer you X for the business, and then I'll give you an uplift of X amount of money if I'm able to achieve this level of turnover within 12 months.
I think that's really important, especially when you're buying service businesses or something that's got IP, which is dependent on the current owner. You've got to incentivize them. Absolutely. So that's what the deferred consideration and what conditions that you're caveating. If I achieve this, because you've got to work, how does that look like in your business?
Yeah.
And is it going to make you money ultimately? Otherwise, no one wants to buy it. I want to touch on what's the success rate of buying businesses from in distress or insolvency.
So
I know it's a key thing for many.
In pre-packs, there is a large proportion that are sold back to the owner managers, a management buyout, the same directors, because of the distress.
In a new structure.
In a new structure, simply because there isn't enough competition, i.e. competitors who understand the process and have the infrastructure to be able to put forward competing offers and use the insolvency regime and the opportunities that brings up to enhance and grow their own businesses. So I think one of the things that we're looking at and have discussed is actually, helping owner-managed businesses, small businesses have, I suppose the first thing is the knowledge of this process, and then the team that they need to support them to be able to play in this field, i.e. to be able to identify an opportunity, transact in 2 weeks, rescue a business, and at the same time plug it into their existing business or run a new business and really grow that way. I mean, if you look at Licenza, which TUPE picked up for little to no money, turned it around and sold it for £10 million. That's an example of somebody who understands the insolvency regime, understands how to turn a failing business into a profitable one, and also more fundamentally understands at what point to exit.
If anyone doesn't know him, Dragon's Den, right?
Absolutely.
Yeah, super.
Indeed.
You had to mention that one. So you see entrepreneurs all across the world taking advantage. It's knowledge, being able to do this and having the team ready. Because in my head, the people you got, obviously yourself, insolvency practitioner, quite a key funnel for the things. The person buying side, accountant, tax advisor, huge, legal person, HR person. I think those are key ones that they're going to have, depending on what they're buying. Maybe a valuation person for if they got property or assets that are tangible. Intangible is a lot harder. You would try to diminish the value of those, to be honest with you, because it's hard to value those. But the tangible stuff, you need to know what you're actually buying, the substance of it, and how to leave the liabilities behind. The question that came to me, by the way, when you were asking about the pre-packs, and I was saying is, if I'm buying a business that I've run into distress, or ultimately, how do I leave the liabilities behind? And not to get any trouble, just some of the things people do. I'm selling it to another business that I'm going to be running. What's the implications if I got debt to our friends HMRC and others of doing this?
So that it's all process driven. So take the scenario: I'm running my business happily. Something happens that pulls your rug under your feet. You fall behind with your creditors, with HMRC. You've got a debt pile that you can't turn around. At that point, you'll probably come and see me. We'll discuss that options piece that we mentioned earlier: CVA, liquidation, administration to rescue, whatever that may be. It's not atypical for directors to want to buy back their business, but without the liabilities. And the structure of and the legislation that allows you to do that is, one, that the business is marketed to the outside world, inviting competing offers from everybody. In that 2-week window, let's say we haven't got cash flow to do anything. The independent safeguard, if you're looking to buy back your own business, is that you need to satisfy an evaluator. That is, there's a small pool of retired insolvency practitioners, former insolvency practitioners, leading professionals in the M&A market that are now evaluators. So their job is to provide a report to independently assess this connected pre-pack sale. It's a legal requirement to get that sign off.
Got it.
But it basically rubber stamps that, one, a process was undertaken and they are satisfied that the sale to the existing directors or the existing management team is the best outcome for all the creditors. And then it's business as usual, whereby the assets are then cherry picked out of the company that's now in administration into a new vehicle. The liabilities stay with the administrator in the shell of the company, and all being well, the new co goes off on its merry way, and I then just take the sale proceeds after costs and expenses and divvy them up as required by law to the creditors.
I guess, what do the creditors say, like HMRC, the banks, if you got loans? How do they see the pre-packs? Because I could see them being not very happy with this.
Absolutely. And there was a fair bit of scandal in terms of pre-packs.
Wow.
Because it was often seen as very clandestine because of the nature of a pre-pack.
Please expand on clandestine.
Clandestine, sneaky, underhand, just looks wrong, right? It looks wrong when you say to someone, I ran into financial difficulty, I dropped the company and bought it back and left HMRC and everyone else high and dry. Optically, it looks wrong, sounds wrong. But ultimately, what's the alternative? The alternative would be that, we've explored the market to try and find another buyer. Otherwise, it would have been a liquidation. And in a liquidation scenario, the realizations are much lower. So what has changed over the last 5 years is it went through a period of consultation. It made awful headlines and wasn't particularly great for the insolvency profession. And so as a result, the first it was known as the pre-pack pool. Now it's an evaluator. It's an independent assessment. From a regulatory perspective, insolvency practitioners are either licensed by the ICAW or the IPA. So when you do a pre-pack, you have to inform your regulators that you've done a pre-pack and provide them a copy of all the reports. So there's a hell of a lot more scrutiny now than there was kind of 5-10 years ago.
Wow.
But ultimately, I know that the insolvency regime and the professionals in the insolvency regime are fully aligned by the fact that if this didn't exist, the outcomes for the creditors would be worse.
Okay.
And one could argue, especially for the banks, that the change for HMRC being a preferential creditor is more of an issue, is more detrimental to the banks than anything else that anyone else has done. And if you're HMRC, you're a secondary preferential creditor after the employees. In an administration, TUPE applies, so the employees are all made good by the purchaser, which means that outside of any floating charge assets, which is intellectual property, everything else is usually then available for HMRC. So in theory, a good pre-pack liquidation would result in employees being rescued. So the National Insurance Fund is saved from having to bail out the employees. That the bank should be getting something out of its fixed charge because you've obtained something for intellectual property that you wouldn't have done in a liquidation scenario. And because of the uplift or the value that you've been able to maintain by rescuing the business, that HMRC should get more money out of an administration, be it pre-pack or trading, than they would in a liquidation scenario.
Wow.
So
there is a lot there, and it's trying to understand, okay, does it, I guess my question is, does it go as a bankruptcy or liquidation against the director, so their credit rating does get hit in the pre-pack?
Very good question.
It doesn't save them from that.
Question I get asked by pretty much every director that sits in front of me. Very natural to assume that you as an individual is the same as you as the director. But they're two very different things. So in your capacity as a director, it's a separate legal entity. The company is not you. You are not the company. So the company's credit rating probably shot by way of CCJs and God knows what before it even goes into administration. The minute it does, credit rating's gone. But you as an individual, well, you're a completely separate legal entity. So it does not affect your credit rating. The only link between the director as an individual and the company is any personal guarantees that are signed.
Got it.
So
so if they got PGs, then
if you've got personal guarantees, you're then on the hook for those after the company's gone into insolvency.
Then you can have bankruptcy. I guess professionals like accountants, lawyers, and all this, if they do a pre-pack, there is other implications.
There is potentially other implications, but that's not to say that they can't do them. Like I gave you the example of the pre-pack sale of a very large law firm earlier back end of last week. But there, for professionals, most definitely, I think there's disclosure to the regulatory bodies.
And then when you do the fit and proper test that they do now, there's a lot of stuff. Agreed. There's a lot of stuff. I want to move on quickly because I know we're coming up to the hour and it's our normal things. Budget.
Yes.
Do you think that's because of the uncertainty? Do you think that's going to cause more opportunities for people to buy businesses in distress?
Sadly so, because I think that everything that's been bandied about has affected confidence, and where there's a shaking confidence, there is people delaying making decisions. When people delay making decisions, it affects somebody else selling something later on or somewhere in the process.
We've caused indecision, haven't we? It's not decisive, and that's when you do these rumour mill, which they're doing. Future plans. Want to go on to this? Obviously, huge synergies between different types of business owners, ourselves, yourself. How do you feel we've touched on this, Renee. The collaboration is key on these, isn't it? Because of the timing, the investment, the knowledge, all working to an end outcome could help so many entrepreneurs, couldn't it, scale their business?
So when I think of M&A mergers and acquisitions, I'm thinking investment banks. I'm thinking, you know, sat on the 40th floor in an ivory tower somewhere in Canary Wharf.
That's in London.
That's not my reality. That's not your reality. That's not most people's reality. What I would like to see is greater access to owner-managed businesses, to small businesses, SMEs, accessing this side of the market, the insolvency market, so that they can come to the table with confidence and increase the buying pool that is able to transact in these distressed scenarios, because it makes my life easier in terms of rescuing businesses if I have competing offers. It makes the insolvency regime more robust because it results in better returns to creditors. And coming back to what we talked about in terms of efficiency of UK PLC, if we're able to rescue businesses and we have the right type of buyers able to rescue the SME market, it props up the bottom.
It's so, but also protects the UK PLC as in employees, because right now we got the highest unemployment for some time because of employee national insurance and loads of other circumstances. I think this is so key. Peter has been amazing. You might have understood why we wanted to cover this, because so many people don't understand where the opportunities are. It's not just trying to grow and scale your business organically. There's loads of opportunities to acquire, and this is why we've been collaborating with Peter around different opportunities for different businesses. So if you've got ideas, if you want to scale your business, you want to know a bit more, drop a comment on whichever platform you're seeing this, and me and Peter will be trying to respond to you guys and try to understand how we can help you. You do need a group of right professionals with you to be able to do these kind of deals, and you've got to have confident understanding of what you're buying, and this is the whole process. Peter, been a star. Thank you so much. That was the Next Level Finance episode, series 2, episode 10. Gotta love it. Please do like, comment, subscribe, whichever platform you're doing, and give us a thumbs up. Thank you for watching this. Really appreciate it.